Welcome to vTalkInsight, Market Drivers Daily for February 6th, 2026. AI spending plans are exploding just as markets punish technology stocks and challenge stretched valuations. So today is about separating enduring growth from capital at risk. Across global technology, the AI story is shifting from excitement about scale to hard questions about returns. Earlier this week, we highlighted that markets were becoming more selective on AI. Now that selectivity is colliding with record capital expenditure guidance. Alphabet is flagging up to $185 billion of AI and data center investment. Amazon is talking about roughly $200 billion of Capex in 2026, and aggregate AI-driven spending by the largest hyperscalers is set to exceed $400 billion within a few years. That underpins powerful secular growth for chip makers and infrastructure vendors, but it also raises the bar for proving that every marginal dollar of Capex can translate into durable cash flows. On the ground, demand for AI infrastructure is still absorbing everything that can be built. Major providers report that all new data center capacity is effectively spoken for, while memory chip supply is tight and fully booked through 2026, creating knock-on shortages for smartphones, especially in China. Power-hungry facilities are clustering in regions such as Southern California, Texas, the Southeast, and the Midwest, where grid constraints already limit site selection and raise the risk of local bottlenecks. At the same time, rapid hardware advances mean parts of today's commercial real estate and data infrastructure could face obsolescence risk if they're not designed to adapt, injecting another layer of uncertainty into long-dated investment decisions. Despite those concerns, there is growing evidence that some AI investment is already paying off. Alphabet's latest numbers show AI solutions built by partners delivering revenue growth of nearly 300% year-on-year, with commitment from its top software partners more than 16 times higher than a year ago, signaling robust enterprise adoption. BNP Paribas has credited AI-driven cost reductions as a key driver of its turnaround and is planning further automation across underwriting and process workflows, while broader banking use cases, such as Know Your Customer checks, are starting to show measurable productivity gains. In the real economy, the United Kingdom has managed modest growth despite an 18-month decline in payrolls, hinting that higher capital intensity, including AI investment, may be providing a cyclical productivity boost. One clear theme is concentration. Most of the economic upside from this AI Capex wave appears likely to accrue to a handful of platforms and key semiconductor suppliers, such as NVIDIA, Broadcom, and a small group of hyperscalers, while many software firms and data aggregators worry that they may not capture enough value from the new stack. Investors are also increasingly focused on who owns proprietary data, because companies reliant on external or aggregated datasets face higher disruption and pricing pressure as new AI tools emerge. Looking ahead, a sustained AI-driven efficiency gain could even influence central bank behavior, with some policymakers hinting at a gradual shift from reacting to individual data releases toward more forward-looking disinflation forecasts that factor in productivity. The key watch points now are whether hyperscalers can turn massive investment into stronger free cash flow, how quickly enterprise AI adoption scales beyond early adopters, and whether power and regulatory constraints start to cap the pace of infrastructure growth. While the structural AI story remains powerful, markets are now expressing it through a sharp tech Led Drawdown. Software and broader technology stocks have sold off aggressively, wiping out about $1 trillion of software market value in a week and delivering the steepest two-day decline in the Nasdaq 100 since August. Negative reactions to heavy Capex plans and cautious forecasts from names like Alphabet, Qualcomm, ARM, and especially Amazon, which guided 2026 Capex to around $200 billion, have amplified the downside. Mega-cap tech is experiencing a rare period of sustained pressure, and the nervousness has spilled over into high-momentum AI trades that have led markets higher for much of the past year. This repricing is driving a pronounced rotation across sectors and assets. Flows are moving out of software and richly valued growth into cyclical stocks, regional banks, consumer staples, and more defensive areas such as utilities, aerospace, and defense, while the broader S&P 500 has slipped in a clear risk-off move. Tech-exposed financials, business development companies, and private equity names are under scrutiny as investors reassess software leverage in older leverage buyouts, and discounts are emerging in some listed vehicles and digital asset treasuries. Risk aversion is also visible in crypto, where Bitcoin has dropped below $65,000 and is trading more like a leverage proxy on the tech complex than an independent diversifier. Beneath the index moves, the trigger has been a spike in perceived disruption risk. New AI tools, including those aimed at financial research and horizontal productivity, are raising doubts about the durability of recurring revenues for low-level or generic software platforms, even as more specialized vertical software is seen as better insulated. Investors are questioning margins and profitability across the software stack, and large Capex announcements that once signaled confidence are now treated with skepticism, especially for Amazon and other hyperscalers where guidance has materially overshot prior expectations. Higher margin requirements at exchanges and margin calls on leverage positions are forcing speculators out of crowded AI and semiconductor trades, with selling pressure now spreading from software into hardware, including names like AMD, NVIDIA, and key Asian and European chipmakers. Set against that, a counter-narrative is gaining traction. Some analysts argue the sell-off in software has gone beyond what fundamentals justify, pointing to strong revenue beats at select companies, robust pricing power where roughly 3/4 of public software as a service firms have raised prices, and solid AI-driven earnings contributions from Alphabet and others. On this view, current weakness is a panic within an intact long-term AI adoption story, and it may create a rich hunting ground for selective stock pickers and for private equity or strategic acquirers targeting oversold names such as Snowflake. However, others see echoes of the pre-2000 rotation from tech into value, warning that a prolonged drawdown in household tech wealth could affect consumption and that a deeper AI-driven sell-off could eventually force a policy response, particularly in Europe where the central bank is watching financial conditions closely. Key indicators from here include the breadth of the sell-off across credit and private markets, the behavior of volatility around upcoming earnings, and whether hardware stabilizes or continues to follow software lower. Valuation has moved back to center stage after a long period where growth dominated the conversation. Markets are pivoting from rewarding top-line expansion at any cost toward prioritizing earnings, free cash flow, and return on capital, especially for capital-intensive AI projects. Large-cap tech stocks illustrate this tension. Earnings estimates have risen, yet multiples in some cases sit near historical peaks, prompting concerns that even small disappointments on growth or margins could trigger further downside. Credit analysts remain broadly comfortable with the balance sheets of major technology companies, but equity investors are more uneasy, particularly when management teams pair ambitious Capex plans with limited visibility on timing of cash returns. Within AI, valuation debates increasingly hinge on data ownership and business model resilience. Companies that control proprietary datasets look better placed to defend pricing power, while aggregators or firms reliant on third-party data face higher risk that new AI models compress their economics. This has contributed to stark underperformance for some horizontal software and data providers, where stocks now trade as if their models are broken even when cash flow and customer retention remain strong. At the same time, some investors argue that markets are underestimating the earnings impact from AI at franchises like Apple, which sits just below its long-term trend line, despite the potential to monetize AI across roughly 2.5 billion active devices. In semiconductors, expectations are extremely elevated, so even strong results, as seen recently at AMD, can be met with sharp sell-offs, underscoring how tight the valuation cushion has become. The repricing is particularly acute in software and alternative assets. Software now represents less than 10% of the S&P 500 after an unprecedented structural sell-off, and valuation metrics are at historically oversold levels seen only a few times in the past 25 years. That backdrop, combined with strong cash generation at some names, is fueling expectations of a material M and a wave as private equity and strategic buyers target depressed, yet high-quality franchises. Yet listed private equity stocks themselves are under pressure, with firms such as Blue Owl down around 50% year-on-year despite solid revenue and EBITDA growth, as investors worry about opaque software exposure and the risk that sector classifications understate true technology concentration in some portfolios. In digital assets, discounts to net asset value at certain treasury holding companies, together with Bitcoin's sell-off and tighter correlation to tech, signal lingering skepticism and the potential for consolidation or wind-downs among weaker players, even as real-world asset tokenization gains traction. Balancing these forces, the current environment looks more like a broad valuation reset than a simple bubble burst in a single pocket of tech. On the supportive side, strong earnings beats at Alphabet, Nordic Semiconductor, and banks like BNP Paribas, alongside Alphabet's AI partner revenues growing close to 300%, suggest that parts of the AI stack are already monetizing heavy investment. On the risk side, the macro payoff from AI-driven productivity remains unproven. Labor market disruption is becoming more visible, and rapid hardware innovation continues to challenge the durability of today's infrastructure and real estate builds. For multi-asset investors, the key sensitivities now are whether large-cap tech can deliver enough growth to justify current multiples, how quickly M and A emerges in oversold software, the evolution of discounts in private equity and digital asset vehicles, and how regulators and central banks respond if AI-related volatility starts to threaten broader financial stability. Across today's session, 3 messages stand out. AI remains a powerful structural driver, but unprecedented Capex means investors are demanding clearer evidence of monetization and return on capital. The tech-led sell-off is shifting leadership toward value and cyclicals while exposing leverage in software, hardware, and speculative assets. And valuations across technology and private markets are resetting in ways that could unlock both risks and opportunities over the coming quarters. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.